So remember one of the drawbacks to using a bank account? If we go back to that whiteboard, over here, this term, lost opportunity cost. So when the money is not in the account, the $4 million we pull out, what happens here is that it's no longer earning 2%. And an easy way to demonstrate that, look at this. If we don't touch it, it's worth 5.8, getting close to 5.9. Over here, we used our money. Then we eventually put it back, and it's worth 5.3 million. So over $500,000 in a difference there, and that's a result of this being outstanding and not earning the 2% interest rate. Now, the whole point of this is I can put it in real estate and earn a lot more than 2%. So I would have probably paid more than $4 million back into the account. But the purpose of me highlighting this point is to state that why we have less here is because we're not earning the 2% on the money outside of the account, which leads into the point of attraction with the whole life insurance policy, where I continue to receive that compounding. That's why I highlight that. I know if you're investing in real estate, you're going to do better than 2%. All right, so let's look at a side-by-side. You know what? Why don't we first do exactly what we did, but with the policy. So here, we've got the policy on the left. There's the 1 million for 5 years. There's the cash value. Here's my annual internal rate of return. Gets very close to 5% as the years pass. Here's the net cash value growth over time. And then here's the total gain on cash value. So for example, by year 10, I've paid in 5 million. The cash value is 6.5 million, which means I have a gain of $1.5 million. 1.5 more than the 5 million I paid in. Now we've got the loan value over here at 95% of the total cash value. This sometimes could be 100%. We're going to look at 100% loan value when we actually look at the comparison here, but it'll range between 95 and 100%. And this depends if you are looking at a cash value collateral loan. Some banks offer a maximum line of credit of 95% of whatever your total cash value is. Some banks go up to 100%. Same thing with insurance companies. Some have a 95% maximum loan value. Some are at 98 to 99%, and some you'll see 100%. So it does depend on the company, product, but generally, as far as how much you can access of your total cash value, it will range between 95 and 100%. Here we're looking at 95. So this column pulls from this just 95% of whatever the total cash value is. So if we wanted to do the same thing, let's look at $1 million loans, years 2 through 5, do we have enough cash value? That's the first question. Yes, if I look at the available equity here, it's 1.78, so it's very easy. This is fun, right? When we look at the numbers. There we go. So there's our loans. Right now we're paying the loan interest, so let's not pay it first. Just makes it simple from money going in versus money going out. So 1 million per year for 4 years, total of 4. Interest rate we've got at 5%. We can make this higher or lower, it's adjustable. There's our loan balance, 4.3 million by the 5th year. And the reason why is because we are not paying loan interest. If we were taking direct loans from a life insurance policy with a 5% loan interest rate and we were not paying the loan interest, you would see this or very, very close to the exact same thing as far as the loan balance with the insurance carrier. This calculator here is meant to represent a cash value collateral loan, which would be a loan through a third-party lender, a bank. Okay, so in this example, if at year 10, we want to put the $4 million back, say in a loan payment, we can do that, but here's the thing with the life insurance policy. The advantage is when you borrow against the policy, the $4 million here, you're still earning that internal rate of return on your entire cash value. However, the loan interest will somewhat offset that. So in this case, we can throw $4 million to the balance, but what happens here? I still have 1.5 left. So my question would then be, all right, with this, I've got $4.7 million. What happens here if I compare it to the bank account? By year 10, at 5.3, It doesn't look that great, does it? No, it doesn't. What if I pay interest? How does it look now? Much better. Now what we're doing, paying the interest each year. So purple represents money going out of pocket here. This is why the loan balance is not compounding. Then I apply that $4 million payment. And now my cash value is $6.2 million. Restored, however, I want to make sure I account for the $1.3 million in loan interest as well. Let's look at a direct comparison here, because we can flip back and forth, but this will be a bit easier. So this looks like a lot. I promise that it's not. The columns that we can actually move here, or that we'll play around with, is what's highlighted in orange and blue. Bank account, everything under green. Whole life insurance policy, everything under blue. And then a comparison on the far right. So what we've got first is just that side-by-side comparison. Quick side note, the loan value is not at 95%. This time we put it at 100%, mainly to keep things simple. So when I look at this without any loans, far right, bank account value, whole life cash value. The first 5 years, the bank account has more. Beginning year 6, I've got more in cash value based on this particular illustration and based on the bank account always paying 2%. Let's look at some loans. Let's do the same $1 million for 4 years. Let's do it here. Look at your total out of pocket too. That came down. So when we look at this comparison, we want to make sure that these total out of pockets for the bank account versus the whole life insurance policy always match. Very important. 1 million. Don't want to pay interest yet. Okay, good. And then loan payments. Why don't we do this time? So a strategy a lot of people will practice, and this is often the logic behind funding a policy for a short period of time, funding it for 5 years, and then year 6, the money I was funding the policy with, $1 million per year, now I'm going to redirect that toward the policy. So let's start with the bank account in this example. Put the $4 million back in. There we go. So again, let's look here first. At year 10, you're at $5.5 million. If you don't take money out, you'd be at $5.8 million. But we did, then we put it back in, and we're at 5.4. Remember, that's the lost compounding. Now over here, premium and PUA deposits, if I can make that fit. Nope, not gonna fit, that's okay. There's the $1 million loans coming out. And if we just start here, let's keep our cash flow consistent. We'll apply $1 million toward the loan for 4 years. What do you notice though? Loan balance. The first 4 years, while we are taking money, we're not paying any of the loan interest. What ends up happening here, I've got a loan balance still of $928,000, and then it begins to compound, and this is at 5%. So let's say you do this. What I'd want to know here is, okay, what's my cash value, my net cash value after accounting for the loan, which is this guy? What's this look like if I ignore the loan forever? I'm not going to pay it back. If I compare it over here, what do we see? Cash value difference. If I'm in the red, this represents how much less I have in cash value directly compared to the bank account. So even with a loan balance here, by year 10, the cash value exceeds that bank account value. However, what if we make it 3%? All right, here we go. Extend it for another 3 years. We'll go back to 2. But it's good to see the numbers here. This is the kind of stuff we like to look at when we're working with someone. Some people like to play around with the numbers, and some say just tell me what makes sense and what doesn't make sense. Always depends. So let's do this now. So here, we've got the withdrawals, then paying it back with our bank account. Here's the policy. Let's pay the interest. Okay. So now what we're going to do is when a loan is outstanding at 5%, we're going to pay the loan interest and then begin to apply funds toward the principal. Now, here's what's important to do here. You may see it, you might not see it. I'm going to circle it. In purple, there's your loan interest payments. Follow the red line. Pay interest to account. So what this represents is money that I would be paying in loan interest, taking whatever that dollar figure is and adding it back to my account value. And the reason why this column in yellow, I want to be identical in both scenarios. Because over here with the policy, remember money going in versus money coming out? Paid in $5 million, borrowed out $4 million, repaid that $4 million, but then also paid interest over here of what would that be? Another $800,000. So my total input, my out of pocket in this particular case is $5.8 million. So I want to make sure with this strategy, it's the same $5.8 million. Now we're not taking into account the fact that the cash value is tax-free on the internal rate of return if we don't trigger a taxable event. We're not taking into account if this is used for business purposes. Maybe I do have an interest deduction there. All of that fun stuff, right, is good for another time, another conversation. Just looking at the raw numbers here. And what do I see? Well, it's close to that 10-year mark. It's the year 10 when I see the cash value have more than that bank account. And we can increase the bank account interest rate again, which will push the bank account a little bit further out. But still, eventually, looking at it long term, we will see that policy produce stronger and stronger results. And if you were to pay the loan off faster, be even more so the case. Let's do this here. What happens if we do something like this? And by the way, this column here is called real estate investment deposits, just to help keep things organized. If I take withdrawals, throw them into real estate investments, and then those investments produce a return, then I'm depositing money from the investment. That's the logic behind the name of that column. So if we do the same thing over here, there we go. Now what's happened? If we pay the loan off faster, the policy will be more favorable, just about. Year 8 in this example, they're neck to neck in year 8. But instead of being positive by year 10, it's significantly positive by year 8. But again, it's all numbers when we look at everything. We can make that bank account interest rate higher. We can make the interest rate on the actual policy loan or cash value collateral loan higher. And we look at them and see which one makes more sense for the individual. And then you can make a decision if it's a fit for you or not. So what we're going to wrap up with here is an example that models policy loans, but instead of looking at a cash value collateral loan, we'll look at a direct policy loan. So this is actually a direct policy loan within MassMutual's illustration software. Fun stuff. And this was run in November. So the loan interest rate was 4.65%. It's a bit higher now, but that's where these numbers came from. So when we look at this, here's the growth illustration. This is the same one we've looked at the entire time. The million for 5 years, we've got the funding, the annual growth, total gain, all that fun stuff. Now we're going to look at this. $1 million loans coming out for 4 years. There's my loan balance. Peaks at $4 million. In this model, we did assume we're paying the interest out of pocket each year. So we have the annual interest that is due, then the interest paid. And then beginning year 6, when we're no longer funding the policy, we begin to repay the loan. So what's beneficial about these examples with direct policy loans, look at the death benefit. So year 2 is when we start borrowing against the policy. Look at the example where we never touch it compared to the example where we do take out loans. We borrow $1 million. How much did the death benefit drop by? Exactly $1 million. So wheat, very easy to follow. Now, when we look at year 5, we've got a $4 million loan balance. The cash value is my remaining equity that I still have access to, about another $1 million. Death benefits 19.2 versus over here. Look at that, $4 million more. So what we did here was model repaying $1 million per year toward the principal. plus the loan interest. Then at year 11, take out a $6 million loan, aggressively pay that down. So we're no longer making premium and PUA payments, applying $1.5 million per year toward the loan principal, plus the loan interest here. This individual is interested in real estate syndication deals, so we've got larger deposits here. But let's look at this to the far right. Total interest paid. It's a lot, right? 7 figures. So what I want to look at here to see if this particular case or this strategy makes sense, how much have I paid in interest? Let's look at the end of this loan term. 15 years in, you've paid $1.4 million in loan interest. What's the total gain? Because the whole purpose of this is the fact that the cash value is constantly compounding. Well, when it's repaid, your cash value is restored to the $8.4 million in this example. There's the total gain, almost $3.4 million. And where that comes from is, again, because you've paid in $5 million, and there's your total cash value. So as it keeps on moving, as time passes, this gets better and better. Then we take out a $10 million loan down here and do the same thing. And we can repay it at a much slower pace if it's a lower dollar amount. Also, a big factor that will impact the values when we look at everything here is the fact that dividends will adjust over time, tracking the actual performance of the policy. If it underperforms, we want to make sure we're aware of that over time. If it overperforms, well, then we're happy because we've got more money than what we thought we would. But having awareness of that up front, and often what we like to do is look at conservative dividends. Perhaps we even look at just the guaranteed rates. This way we can have transparency up front to know, okay, worst case scenario, here's what the numbers look like. Am I still comfortable with this? If I'm not, that's okay. We just want the awareness up front. That's the big thing. And then what we looked at was a couple other scenarios. Here's one with no repayments. Did have a question on this to say, hey, if I just pay in $5 million and then we borrowed out $4 million, which puts my net out of pocket at $1 million, never pay anything toward the loan interest, just let that ride, what happens? Well, here's the loan balance. But then if we look at the cash value and death benefit, these are pulled from the illustration. Those are my net values. I recover my $1 million by year 12, got a nice death benefit, and continues to compound, which is nice. Definitely want to look at that with a conservative dividend and or a higher interest rate, but looks good in this particular case because I've still got another $1 million that I've paid in and haven't touched. And then we've got several other scenarios. In any event, I hope that this video was informative. If you have any questions or comments, please leave them below. If you enjoyed the video, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.